All right, we're going to get started here and people can just join as we get started. So what we're talking about today is indicators. I'm going to put that up here. And let me know if you guys have any questions as we go throughout this, and I'll make sure to do my best to answer those. Let me get the chat pulled up here. Just make sure I'm not missing anything. Okay. Okay, so this class is going to start. So basically what we're going to be going over is a few different indicators that I like to use. I know that you can go on the internet and Google search any of this stuff and watch videos on any of these indicators. So I'm going to show you the ones that I like to use personally, and we're just going to roll with it that way. And then if you want a more in-depth about what they are, what the actual settings, things like that, you can Google that stuff, or it has it right here in Thinkorswim. But I'll show you guys kind of how I use them. So basically, first thing I want to go over is if you haven't seen my first two lectures, I want to make sure that you go and do that first, because that's more important than indicators. I think indicators, a good way to describe it is it's a secondary confluence. So like, I would say that this isn't like indicators is not a primary thing you want to focus on. Like, what you want to focus on is price action. That's the number one thing you want to focus on. Risk management as well. These are my top two things, and I preach this to you guys all the time, as I'm sure you know. Price action is key. Risk management is key. These are the two number one things you want to focus on. Indicators just add to it, make your life a little bit easier, but they can also make your life a lot harder because it can cloud your judgment a lot. So I'm going to try and make it as easy as possible for you guys and give you the ones that I like and the ones that I use. And we're going to run through it that way. And like I said, if you have any questions, let me know and we will get that squared away and I'll answer those for you. Okay, so first thing is prioritize price action. So watch the first two webinars that we've done recently in the past couple of weeks. Please go watch those first before you go and try and master all these indicators, because you're not going to get anywhere if you don't understand support and resistance and also how to manage risk. I go over it 1,000 times. If you go look at my tab or the outsourced education tab in the Discord, you'll see a ton of information to get you started. But definitely these indicators, this stuff will help. But I just really want to make sure I hone in on that. Yep, same thing here. Understanding trend, support and resistance levels, and market structure. Market structure is pretty much the same thing as the trend. Like, is the stock going up or is the stock going down? Like, as you can see, this is pretty consistently moving down just based on when we look at this chart. That's the trend. So next thing we want to go to is these indicators are lagging. So that's why I say price action is most important. It's because price action is what comes first. All these indicators that you guys watch and see people use, they're lagging. It means they're behind the market, and the price action, like how it's reacting to these levels, is real-time data. The stochastics, the MACD, the squeeze, all this stuff is lagging, and it's not current information as it could be with like levels. So the only one that is not considered lagging is volume, and we'll get into that more in a second. But so yes, okay, so the next point I want to get across is that indicators are not useful on their own. Like, you can use them, you can pick your favorites, the ones that you like. I don't use all the ones that I'm going over today, but I know some people requested to see how to use these other ones, because I'm sure like other mentors and things like that use different indicators. But I'm going to go over the ones that are important to me. But you need context with these indicators. You can't just expect to use one indicator and expect it to work. For example, like if you've ever seen the MACD, I'm going to go in and show that to you guys. I'll add it to the studies here. So there's a way you can backtest. You can buy programs to backtest things. And I was just curious one day and I went to backtest the MACD. So the idea behind the MACD is, it's this one here at the bottom. When this blue line crosses the white line, that means it's a buy signal. And when it does the opposite, it crosses below the white line. The blue crosses below the white line. It means that it's a sell signal. So you're basically supposed to sell the stock and buy the stock when it starts to curl and cross here. And so I did a back testing on this on the S&P 500, and basically what it showed is that if you just hold the S&P 500 over a long period of time versus buying it when it says to buy it and then selling it when it says to sell, just based on this indicator alone, you're going to make less money than versus if you would have just held on to it the whole time. So that's why I'm saying it's very important to understand these in context. They are secondary to support and resistance, and you can add, basically you want to add these to the price action. These are just to help you. You don't want to have this be the one thing you look at and you take trades based off it. No, you don't want to do that, because you're going to end up getting burned. Trust me. There's way too many gurus and stuff like that that will tell you that you need to focus on this one indicator and it will get you where you want to be and make money consistently. No, you like, these things are all secondary, and I really want to hone in on that. So next thing I want to share with, so now we're going to go over some indicators. We're actually going to get into it and actually talk about the indicators that I like. So the first one being volume. The reason why I like volume is it's because it's the only non-lagging indicator. So like when I say that, when I was talking to you guys earlier, like price action is a live indicator. Like it will tell you what price is doing at that very moment. The MACD will tell you in delayed time what's going on with the stock. So it's always behind whatever the stock is actually doing. And that's the big difference between understanding price action and understanding indicators. Like these indicators are secondary to price action. So make sure you go see those. I'll stop repeating that, but I just want to make that very clear. So volume is the one thing we're going to focus on right now, the first indicator, and I'm going to move this off. And so volume is right here. I'm sure all of you guys have heard of what volume is. Basically what it is each one of these candles has a volume bar that correlates with it. So like you see this big green candle here, this shows, this is how much volume came into that candle, meaning the buying and selling of shares. So when you look at this indicator, this will indicate to you how much buying and selling of shares, like how many shares are traded within that period of time. So like this is a 1 hour chart, and you can see on this right side, or up in this corner over here, this will tell you how much actual shares were actually traded during that period of time. It's not that valuable of information to know how many shares being traded, but it's good to know in relation to all these other bars, if it's low volume like this here or high volume here. We want to look at these high volume areas where there's a lot of shares being traded, because that means people are interested in this stock at that period of time. And so that's what we want to focus on. So like it will tell you the exact amount of shares over here, but mainly what we're looking at is, okay, this had a lot more volume in comparison to this candle here. So like we will put more weight on what's going on this candle, because there's more people interested and more people actually trading the stock at that period of time. So the best way to go about this is just focusing on how volume affects certain candles and how it reacts to support and resistance levels. So for example, if we go look at this support level, I don't know when I drew this, it was a few days ago, but we're just going to use it for the sake of example. So notice how we had a nice rejection off this candle here, and notice how we had higher than normal volume in comparison to the last 5 bars. That's what we're looking for. We're looking for when it reaches these support or resistance levels, we want to see a strong reaction, and volume kind of complements it as well. And this bar will change and move up in size as this candle is forming. And this bar isn't finished until this candle is finished forming. So I hope that makes sense. That's what volume is. So volume tells you how many shares are traded within a period of time. I like to use this. What I actually wrote in my notes for this is it's the only non-lagging indicator. So it means it updates in real time as the stock is moving, which these do not. It'll update when the candle closes. This one will, this one will, this one will. All these other ones will. Volume is the only non-lagging indicator. So information is shown in real time. Is most importantly how I use it, how it reacts to support and resistance levels. So like here, look at this high volume candle. When it came up and rejected it perfectly, look at that high volume that it had on that rejection. So that's something we want to take note of. And typically it continues, and it never came back up to that level and had a nice drop after that, which turned out to be an 8% drop, which is a huge move in options and short-term trading. So those are something that we want to pay attention to when it comes to these support and resistance levels. And like I said, go check out the support and resistance webinar we did last week. That will give you more context on this. Also, when you see a stock is pushing, what you want to look for is, so like the other day when we saw SPY, the S&P 500, when it just had a day where it just kept going up and up and up, this day here, you want to pay attention. This is probably the most useful it is. When you see that a stock is pushing on this volume, you don't really necessarily want to get into this stock if, see how it's continuing up here, but volume is continuing down. Like, so volume is decreasing here, but price is increasing here. This is not something you want to see to make you buy into a stock. It's just not something that, I know it may have worked out this time, right? But it doesn't always. And so that's something we want to pay attention to when the stock keeps pushing up or it keeps pushing down. See here, price continued to flush down, but volume increased. That's a good sign that buyers are stepping in. So personally, I would feel more comfortable getting into a stock, buying puts in something like this, because we have continued high volume increasing as we go down versus slowing volume as we go up. So that's something that I like to pay attention to when I'm looking at volume. So really that's how I use it. That's pretty simple explanation, but I like to watch it around support and resistance areas. And then I like to watch it when a stock is making a really big move, if it's really going to continue. So next thing we want to look at is that's volume. The next thing we want to look at is RSI. So RSI, I'm going to get that pulled up. Basically what RSI is let's see, I'm going to add it to my studies. I know I got a lot of stuff on here, but it'll make sense when I put it all together. So RSI. Oops. I think I added it too much. Okay. So basically what RSI is, I'm going to bring all these down and make this one bigger. So RSI is this one here. Okay, so basically what we're looking at here is all this does, it's a very beginner, someone that's beginning trading, looking to learn more about trading, they will probably be directed to the RSI. I personally do not use it. I don't like it that much, but it's a good thing to take note of. So for example, it shows when stocks are in oversold or overbought conditions, meaning that the price price is moving up, it's getting too hot at that point and is not, like, it's too high. The price is too high. That, like, this indicator basically tells you, okay, too many buyers have stepped in. It's got to start cooling off at some point because just price has moved too high too fast. There's not enough pullbacks. We need to see a pullback of some sort. So a good example of that would be here. So as you can see here, you can see that when it goes over 70, that's considered to be overbought, meaning too many buyers have stepped in, it needs to cool off. And then down below 30 is considered to be oversold. So basically what that is that this is indications of when you may see a bounce. So for example, if you're looking at this in conjunction with support and resistance levels, you can see that this was oversold, meaning there was too high of selling pressure and it just got to the point where there's no more sellers anymore and it's too oversold. And so basically that's what you saw a big bounce. That's what we're looking for. And so that's typically how people use the RSI to see, okay, the selling might be over. We might be wanting to look for calls. And I definitely don't want to get in puts because we're oversold at this point. Or opposite side, okay, we came up here and you can see as we got here, we're very overbought. Like there's too many buyers that stepped in, and at this point we're overbought. And so the whole idea is that, okay, now too many buyers have stepped in. At this point, we need to start cooling off. I don't want to look for calls at this point. Maybe I'll just wait it out or maybe look for puts. So that's the idea behind this here. So when it gets over the 70 mark, that means it's not a good idea to get in calls. There's too many people already trying to buy calls. And then vice versa. It's too oversold. You don't want to look to get in puts at this point. You missed the move. So that's how people use this. I don't use this, and all these indicators you're going to see have their flaws. That's why you don't want to use it as a primary thing. It's supposed to add to your trading game and not be your trading game, if that makes sense. Like you don't want this to be the all or nothing and decide whether you're going to make money off of it. Because if everybody used the RSI and they made money off of it, nobody would be doing anything else. So and same with all of these other indicators. You need to use them in conjunction and have multiple reasons to get into a trade. So that's the gist of RSI. I know I'm doing brief overviews. If you really like something, go on Google and watch a YouTube video on it and it'll do a great description. But I'm showing you how I've learned to use these indicators. So that's RSI. There's the overbought and oversold conditions, and that's what we're looking for there. And then if we go to the MACD. So basically what the MACD is that we kind of went over it a little bit earlier, but I'll go more in depth. It's meant to show momentum. So like you can see these bars as they're highlighted a brighter red and then they turn to a darker red. Dude, get out of here. Sorry, that's my dog. Dude, go. Sorry about that. So basically what we're looking for in the MACD is this crossover. This histogram where it shows these colored bars, that kind of gives you an idea of where the momentum is heading. So for example, when you saw this, and then the crosses are meant to show the same thing, that basically buyers are, when the blue line crosses below the white line, that means that buyers have, or sellers have begun to step in and they're kind of taking control. So that's the idea behind the MACD. So as you can see the cross here, it didn't really go much higher after we had that cross. I think this is a valuable indicator. I use the squeeze more. They're very similar, but it's the same idea, but staying focused on this. So you see this crossover here, and then you can see how price continued to go lower. So that's the idea. And then when you see here, when price crossed back over the blue line, or not price, but the blue line crossed over the white line, now you can see that, okay, when that happened, we continued a steady uptrend from there. And this was where it crossed. Right here. That's where the cross was. So you can see the cross happened on this candle here, and we continued up from there. That actually looks very good. So, but you can see how in some examples, it doesn't always work out like that. That's why these aren't all the be all, end all be all, whatever that saying is. So basically, you can see here, same concept, cross happened, but it didn't work out. The buyers didn't end up stepping in like we were hoping. And yeah, so that's the idea there. So basically, to keep it very simple, the cross over the blue above the white line is supposed to be a buy signal. What I like to do personally is anticipate this cross. So like I saw here, this histogram starting to get overextended, right? And I've got other reasons to be in the trade. So like it's at support here. It's overextended. This blue line's overextended and they're pretty far away from each other. And I'm kind of anticipating the cross, and we'll get in before the actual cross happens, when most buyers are going to step in. Like if they use the MACD and they run off that, they're going to get in when this cross happens. I'd rather be in here and then still follow the move after that, and still be, or even get out when the cross happens, because at that point I'd be up a good bit. So that's the idea behind the MACD. So there's a cross. This is a buy signal here, and we've got a sell signal here. And this also can act like when it crosses this purple line where right here, this can kind of give you an indication whether this is a like this is the line in the sand, basically. Like this could be considered oversold conditions like the RSI, and this can be considered overbought conditions. But for now, just focus on the fact of the crosses, because that's the main purpose of this indicator. And so now we're going to move to the stochastics. So the stochastics basically is a combination of the RSI and a combination of the MACD. And that's why I like this one, because it's a combination between the two. So like the reason why I like that and prefer that is because it kind of does both at the same time. So like it gives you the actual overbought and oversold conditions that the RSI does, but it also gives you this cross signal line that the MACD does. So that's what I like about this. So there's, for example, same concept, the cross, but they're just different colored lines, but the cross below the orange line cross and the purple line, that means sellers are stepping in, right? And then opposite here, buyers are stepping in. That cross happens in an oversold condition that can give us more confidence. Okay, and we're at support. We have this cross, and you can notice this acts a little faster than the MACD as well. That's another reason that I prefer it. So I'm going to get rid of the RSI because I hope you guys understand that concept of the oversold, overbought. You can still see it in the other as well, but I'll get rid of that to clear up the chart a little bit. Okay, so I'll go more. I do not use the MACD. I do not use the RSI, but I wanted people wanted me to go over that. They requested that I would go over that. I use volume, the stochastics, and the squeeze. So we're going to go a little bit more in depth into the stochastic slow, and specifically I use the stochastic slow. There's multiple different ones on Thinkorswim and all these different platforms. I specifically use the stochastic slow for whatever reason. I find it to be the most useful. And we're going to dive a little bit more into that. Okay, so you can see, like, for example, it's not always accurate, right? This is oversold conditions. We're having crossovers, blah, blah, blah. And this was actually a tough trading day because it just kept pushing. All these indicators are giving me conflicting information. And that's why you don't always want to run with indicators and let them make the decisions for you. Because if you would have based your decisions on the fact that it went over this price, came back, retested it, and had a nice candle rejecting it, then this would have been the reason to get in calls and it would have paid. So this is the reason why I want you to learn support and resistance and have that above all. So what we're going to go over here is, so we'll look at a couple examples of this because this is an indicator that I do use. So like, for example, something that I would have paid attention to is, okay, we're in oversold conditions. We're having a cross, which if you look at the MACD, this is the same area right here, haven't crossed there, but this tends to be quicker. Even though the word slows in it, it tends to be quicker than the MACD for whatever reason. I don't know why it's named that, but I like this indicator. So that's something I like. Okay, we have a nice hammer candle. If you watched our webinar from last week, we have a nice candle here that's rejecting support. And then we have a cross here in oversold conditions. This is a perfect reason to get into calls. So then if we go look, try and find a better example. For example, here we have another one that just happened the other day or on Friday. Oversold conditions, we had a cross, and then look where we're at, right at support. We may have not held it yet. You might have got faked out on this candle, but the same concept is there. It was oversold. We had a crossover, and boom, we got a pretty decent move to the upside. I mean, if you would have got in at support here and not got stopped out by the end of close, it was a 0.5% move, $2 move, that would have been $100 in your pocket each contract, relatively. So that's the idea behind that. Okay, so if you guys have any questions, let me know in the chat. I'm keeping the chat open to make sure, or if I just miss it in the chat, just message me in the trade floor and I will make sure to answer that. So I hope all this is making sense so far. Let me know if it's not. But we're just doing a brief overview of each of these. So I like to use this one. I use this one. Like I said, I use the other two here. This is what my typical setup looks like. I'm going to get rid of this. And we got one more indicator to go, or two more indicators to go over. Sorry. Okay, so I use stochastics, volume, the EMAs, which we'll do last, and then the squeeze. So the squeeze is something from John Carter. When I first started trading, I've been using this since like day one. I just found that I really like this indicator. It works well. And so the gist of it is that basically when price starts to consolidate, and price action starts to get tight, it's setting up for a bigger move. Like we're basically looking for the consolidation and then the break. So like, I'll show the exact point where it starts to show the squeeze. Okay, so in this example here, we have a squeeze all the way until here, right? Okay, so basically the idea behind this is, okay, so these red dots, these red or black, red dots, whatever, when these are not green, that means we're in a squeeze. And that means that we're basically setting up for a big move. And that's what we're looking for. So personally, this is probably one of my favorite ones that I watch. It's not necessary, but it's just a good visual to know, okay, we're getting ready for a big move in the market. Let's pay attention to that and see if we can get on the right side of it. So for example, like if you know anything about formations or patterns, we have this pattern forming here. It's called a bull flag, if anybody doesn't know. Go to the outsourced education tab if you want to look at that. But this is how I actually did play this trade. So basically, we had a squeeze, right? We had the oversold conditions a little bit here, right? We're at support. We're holding support. We're kind of not holding it the best way, but we're holding it somewhat. I got in on this candle here when we had the break above, retest, broke back above it, and then I played that move from there. So basically what you're looking for is we have first, we're at support, we're in a bull flag, a chart pattern that looks good to us, that makes us lean to be bullish. And then we have this squeeze setting up. And as you can see, when the squeeze fires off, which it did here, we had a pretty great move after. So that's the reason why you want to use, that's why I like this indicator, because if you look at this, the moves aren't as good when it's not in it. It just kind of depends. It's just a useful tool to look at more than anything. I wouldn't say it's an end all be all, and I wouldn't be offended if you didn't use it. But like, I just find it useful for my own personal use, just because I've been using it for so long. So basically, that's the whole point of that. It's basically meant to show consolidation, and it's visually shown, which is helpful. It's not needed, but helpful. You could tell that this is consolidation all in this area, but it's just a helpful visual to just give you extra confirmation, right? Make it a lot more simple for you to decide which side of the trade you want to get into. And yeah, so that's the whole point of this. You're just trying to get on the right side of the trade and waiting for that big move to happen. And so you use everything in conjunction on the charts with your indicators, and that will help you get into the right trade. So the last thing I want to show you guys, let me know if that one doesn't make sense. I kind of went through it fast. It's not really much to it. It's supposed to show consolidation, and then based on what you see on the chart, use your best judgment to get on the right side of when this squeeze fires off, per se. So like when these dots turn green, and this histogram where it goes up and down is meant to help you see the momentum. The same idea as the MACD, just trying to show you momentum. And so the last indicators that I want to go over for you guys is the EMA, or simple and exponential moving averages. So basically, I'm going to show you how you set these up, because then that will help it make more sense. So the idea behind these is that they show trend, right? So basically they help you see how the stock is trending. They're lines in the sand that show you, they act as support and resistance in a way, but they show you how price is moving. You can see how they kind of match up with these and kind of continue. Okay, I got a question. Sorry, I didn't see that. On the squeeze, why is it green dots even when the candles are red? So the color of the candles do not correlate with the actual like these candles, the color of these candles don't correlate with this. So basically these red dots are meant to show, or sorry, when it's like black or red dots, whatever, not green dots, that's just meant to show consolidation, that the price is not really going anywhere. And then these green dots are showing, okay, the stock's making its move now. Like it's happening. Like this is like, okay, get ready for it, get ready for it. And then this is, the green dots are basically saying, okay, it's happening now. Like it's already happening. You missed it. You're not in it. If you're not in it, it's already happening. So that's all that is. It's not supposed to be in correlation with whether the candle is green or red. It's just saying, okay, the move is happening, basically. To indicate, it's telling you what the that this squeeze that it's showing here has fired off and is now happening. Like it's making its move. So let me know if that doesn't make sense. I hope it did. So next, back to these EMAs. So basically what you're looking for is these show trend, right? So basically the point is that these show trend. I use these actually, everything you see on my chart here, I use. So this is the 9 EMA, which is an exponential moving average. And then this is also an exponential moving average. So there's two different types of moving averages. There's a simple moving average and an exponential moving average. These ones you see on my chart are exponential moving averages. So basically the point of these is that it shows you the trend. So you can change these as you want. I use them as, I use the 9, which is this blue one here. And then I use the 21, which is the purple one. So basically what these is you type in a length, it gives you the length, and that's where I'm getting these numbers from. And basically what these do is show, okay, so this purple line, what it's showing is, if I go back to over here, where this purple line is at currently is basically what that's telling me is that over the past 21 candles, this is where the average price. Now this blue one is over the past 9 candles. So 1, 2, 3, 4, 5, 6, 7, 8, 9. So since this candle here, this is the average price. So that's the reason why I use these, is because it'll give me analysis of what the overall trend of the stock is and whatever time frame I'm looking at. It'll change based on the time frame, but basically what we're doing here is it's just an easy visual to say, okay, so you don't have to sit here and say, okay, is this stock going up? Is it going down? I don't know. These will help you just tell, okay, this stock is trending up. So when the 9, the shorter term, is above the longer term, which is the 21. So this is the 9, this is the 21. When this shorter term one is above the longer term, that just means that we're in a uptrend currently. And then vice versa, when it crosses here, that means we're potentially starting a downtrend. So there's 2 different ways to describe this. So first, there's one called a golden cross. This can be used on any type, whatever. If you put 50 in the settings, if you put 22 in the settings, or 45, whatever you put, 100, 200, whatever you put, there's a general concept behind it. So stick with me on just these 2. So these can be whatever it is. So there's a longer term and a shorter term trend, right? Or a shorter term EMA. So what we're looking for here is basically when it crosses to the downside, this is called a death cross. This means basically the stock has given up its uptrend and is now starting a downtrend. That's the idea behind it. So you can see when we have this cross, okay, it has a steady move down. Okay, so now that's called a death cross. Now there's a thing called a golden cross when a stock crosses up, like, or when these two EMAs cross upwards. So for example, right here, this is considered a golden cross. So the cross here is a golden cross because basically it's changing its momentum to go up. It's the same concept as the MACD, same concept as this. That's what this is. When these cross, it means it's starting an uptrend. Buyers are stepping in and now the trend has changed. And then same thing when it crosses below, like right here. The 9, the shorter term, crossed below the longer term, which is the purple, and now we've started a downtrend. So you can use this with any type of EMA you want. So that's the gist of this. If you guys have any questions, let me know. But I'm just giving a basic overview of how I use these. And if you guys want to take a screenshot of this, this is my class notes about all of these, so it can give you an idea of what to remember and what's most like the notes that I gave. So there's like the golden cross, basically what that is when the EMAs cross, and then there's the death cross, which is the opposite when the shorter term moving average crosses below. And there's one more thing I want to explain to you guys. So there's simple moving average and exponential moving average. Simple moving average takes, so stick with me on the 9 EMA here. If it crosses, or sorry, there's the 9 EMA. Exponential moving averages put more weight on the last few candles, when a simple moving average focuses on all 9 candles. So simple moving average focuses on all 9 candles, and or all 21 candles if you're talking about this moving average. But as for simple moving average, which I don't use personally, I use only the exponential moving averages. Basically the simple moving averages takes all 9 candles as equal weight of each candle. It takes equal weight, but the exponential moving average takes more weight on the last few candles. So that's the idea behind that. So yeah, if you guys have any questions on that, this is recorded. I'm going to have it uploaded tonight, and you'll be able to review it. And if you have any questions, just message me in the trade floor or message me directly. But yeah, that's all the information I want to share with you guys. This is my exact setup. I'm not hiding anything. This is exactly what I use. I use the volume, squeeze, stochastics, moving averages. No problem, Serge. I hope I said that. Cedric, thank you for coming. If you guys have any questions, let me know, and I will be more than happy to answer them. This will be uploaded tonight. We got webinars every Sunday at 8 p.m. Same format. I get feedback from you guys on what you like, but let me know what you do like and don't like and what you want to have covered, and I can easily do that for you. Thank you guys for coming. This will be uploaded every Sunday. Stay tuned. Watch the other ones if you haven't, and have an awesome night, and let's crush the markets tomorrow.